European Central Bank cutting its interest rates today, the first time since 2019. The move comes after the Bank of Canada cut rates yesterday. Will the Fed follow its peers sometime soon? Well, joining us now is Seth Carpenter. He is Morgan Stanley's global chief economist. Seth, it's great to have you on the show. I'm going to start right there because I realize ECB cuts today, but they were also very, very cautious in the language they used to couch that 25 basis point move. We know it's baked into the market. The Fed's made it pretty clear with a meeting next week. We're not going to get cuts. But how high is the bar, especially as other central banks start to move, for the Fed to actually begin to do the same?
I think it all comes down to inflation and how the inflation data come out over the next several months. So we actually have a baseline forecast of 3 cuts this year. So that's more than what the market's pricing. And we think what's going to happen is we'll get CPI next week. We think that's going to show further disinflation. It's going to reinforce the idea that the first quarter high inflation data were noise and not signal. And then that's going to get the Fed more comfortable. And then as we get another couple months, by the time we get to the September meeting, we think the Fed will be ready to cut. I think what we saw from the ECB today, the cut that was already baked in, but then that very cautious tone where they want to wait and see how the data turn out, that's where central banks are right now. We went through an explosion in inflation, an episode very few people have seen it. We haven't seen it in DM economies in decades. And so they think they know where they're going, but they really want to make sure they get this right.
So on the one hand, we know labor tends to be a lagging indicator. We also know that some of the data we've gotten, even just this week, shows signs of softening in the labor market, which perhaps makes tomorrow's jobs report that much more important. On the other hand, we had Paul Hickey from Bespoke on yesterday, and he looked at the data over the last 30 years, and he said there's only been one time that the Fed has cut between May and November in an election year, and that was October of 2008. So where does that leave us?
So I think you can probably pick out all sorts of facts in different ways. I will say from personal experience, I was at the Fed for 15 years. The 2000 election, I was there, 2004, 2008, 2012. That place actually really does hew to their dicta of being non-political. And the fact that it's an election year, I really don't believe for a minute has anything to do with what they're going to do with policy. They're looking at the data. They're looking at their forecast for how the economy is turning out. They're going to try to make the best decision they can based on the available information.
Seth, I wonder what 3 cuts, where you're still targeting right now, means in the sense that 2 months ago, I think the market would have taken the idea of 3 cuts as, yay, stocks can go higher because, conditions will be. But today, the idea of 3 cuts, when you just had this hawkish cut by the ECB and concerns that the working class consumer is really slowing, it could actually signal, well, maybe stocks can't go higher because maybe the economy overall is struggling, and that's the only reason you would get to 3. Well, what do you say?
I mean, I take your point that the driver of the 3 cuts, what causes interest rates to come down, is every bit as important as the fact of interest rates coming down. So in that regard, I completely agree with you. I would, however, take a different view here. We think the non-farm payrolls report that we're going to get tomorrow is actually going to be a little bit stronger than what we saw last month. We think some of last month was overdone, and we'll get a little bit of a payback. The main reason why we see the Fed cutting this year 3 times and not what the market's pricing is because we think inflation will actually come down more than what other people are thinking. And I have to suspect that that's just a good thing overall for the economy. For the lower part of the income distribution where we're starting to see people struggle, lower interest rates will make their interest expense lower as well. So it will end up supporting things a bit.
So tomorrow, what's more important, the overall headline number or wages?
I think they're both right in there. It's interesting, though, because we're looking at just a little bit over 200 for the headline number, 180 something for the private number. So like I said, a bit better than consensus, a bit of a payback from last month. But there was a time when consistently strong jobs data like that would have caused you to think, well, gosh, is the Fed going to be able to cut at all? And now we're in a place, because we know the labor supply has been boosted by this immigration surge. Chair Powell's been saying we've got a bigger economy, not a tighter economy. And so I think the jobs report is actually only important if it shows a lot of weakness. I don't think at this point either wages or stronger job growth is going to be the thing that moves the Fed.